When we talk about Forex trading, there are a lot of things that actually come in our minds when it comes to strategies, trading styles, and so on. But there's one simple trading style that pretty much nobody talks about, which is institutional trading. And in this specific video, I want to give you what I consider to be the best Forex strategy for day traders or maybe even swing traders, but the one that only quiet traders are actually using that are given the most profits in their trading accounts. Hi everyone, this is Christian here on YouTube and welcome to a brand new video for the channel. As usual, if you're new to my channel and you're into Forex trading, crypto, or any type of making money online, I would love to ask you for a like in this specific video, subscribe to the channel, and also follow me on my social media as I'm always posting content in regards to day trading in general. So with that being said, let's jump into the video. The first thing that I want to talk about today is what is institutional trading, because I know probably some of you guys have no knowledge in regards to this type of trading at all. So basically, institutional trading is what is trade like institutions do. For instance, the banks in Europe, the US, and everywhere in the world usually buy and sell currencies on top of different currencies. For instance, the euro against the US dollar, the British pound against the Japanese yen and stuff. So they actually make these movements with big amounts of money in order to make profit from the actual foreign exchange market. So whenever we are talking about institutional trading, and if you actually try to look it up online, you're gonna realize that there's not much information in regards to it. There are a couple of videos where there are interviews and stuff, but nobody actually shares like what is institutional day trading per se. So I don't know if I'm one of the pioneers of talking about this, at least in English, but I'm gonna try to actually cover as much information as I have. And if you're able to catch up and follow along, hopefully you're able to make some money as well. So institutional trading, again, basically what it is, let me just go ahead and get my pen. Institutional trading is identifying when big movements are actually happening in the market from institutions that are, I'm not afraid to say it, manipulate the price of an asset. So it could be, for instance, right here, and this price right here, and then it jumps and does this. This is a big price manipulation that could actually be happening from institutions. Same thing right here. This could be happening from institutions as well, and so on. Now, is there a way for us to know specifically when institutions are actually buying or selling? It's impossible to know, but we can have an idea as to how they do it. Now, there are two ways to actually know how institutions are actually doing this. The first one is something called imbalance trading. Imbalance trading, basically what it is finding areas in the market where it moved so hard that it created an imbalance in the market. The markets and the price of the asset has to be balanced. So it cannot have those crazy movements and never recover and stuff like that. Obviously, during the pandemic, this stuff kind of happened. But then there is some sort of imbalance areas where we need to actually pay attention to. For instance, there are certain spaces in the market. This jump right here that happened and then all this huge drop left all this place as an imbalanced price of the market. So we need the price to actually go back to the area and pretty much fill out all the selling orders that were open at that time so that the price can continue its distribution. What do I mean by imbalance trading? We're going to identify this literally right now. Right here, I actually, I'm looking at what happened a few days ago. Well, not a few days ago. This was in July. And some of the trades that I placed in the past, learning or understanding the imbalance trading. This literally right here looks like an imbalance type of thing. So what is it that we are going to do? we are going to identify an imbalance trading by the empty spaces that the market is actually living. So we realize right here that the price actually jumped incredibly hard in this area. So we're expecting the price to actually drop again and get all of these pending orders. This is where institutions place their pending orders, right here in this area. And I'm gonna tell you exactly why. But here's an imbalance. Here's a consolidation of the price. Here's a distribution. Then it goes back and gets the orders again. And then it pretty much complete the transaction orders. So as you can see right here, and let me just go ahead and slow it a little bit more. It literally activated all the buy-in pending orders that the institutions had, and obviously some of the traders, and boom, it filled it out. Could it be higher? Yeah, it can go higher than that. It could be lower than that. We're going to talk about how is it that you're supposed to identify those entry points in just a little bit. And here we are going to find a new opportunity. Again, what is it that I actually look at? I look at some huge movements that will leave a space empty, which means the market is not balanced anymore. Why? Because the big movements, the big probably news going on and stuff actually left the market without a balance that it was having inside of the consolidation. So what happens here is that what you do is that you actually wait for it. I activated my order and then I wait for the price. If you notice, the price went down to the actual order area. Like this is a sniper entry, okay? Because it actually went into the actual buying order area right here and he activated. It was barely in the stop loss area, barely, like almost zero drawdown, okay? So this is what imbalance trading actually is. Now, there's one more way to actually identify institutional trades, and that is with order blocks. An order block, which is something that happened literally right here. An order block is identified by the last candle prior to a big movement in the market. Right now, I'm looking at the 15-minute chart. And if you notice right here, there was a big movement. So what we need to find is what was the last opposite candle prior to that movement, which is this red candle right here, right? You see it? Perfect. So basically what that means is that at the moment that this candle formed, it gave us this order block right here. So the price went into that place and it got back in the exact same spot, activated, and then it gave us the entry point. It gave us the profit of trade. This is a new example. What was the last candle? This one right here, because this is a big movement. It's a big movement. Okay. So once we actually see that, we see right here that the price literally touched right there and it went straight to the profit. Now, how do you identify like the order block per se? The order block, first of all, if we notice the imbalance trading, the imbalance, we can identify it as it is right here. We see that there is a time of the pair where it's not moving too much. It's just pretty much bouncing or dancing around right there. And then boom, it got shot. Now you can actually leave the entry price right here, and then the take profit. We're going to talk about how is it that I choose the take profit and stuff, but you can actually enter right there, or you can use a combination of the two ways of trading, which means a combination of imbalance plus a combination of an order block, which is exactly what we did right here. So here I actually found this trade. This you can literally ignore it because I canceled it. I didn't enter. So I'm just going to delete it. But here I actually saw something interesting in this specific area. I saw that this was an order block right here. This is an order block, the candle entirely, including the wick right there. That is an order block. And I also saw some sort of consolidation in this area. if we actually go into 5-minute candlesticks, we're gonna realize that there was a consolidation of the price, and then boom, the price started to distribute all the orders. All the selling orders were right here. So I noticed that this could actually be an order block. Now, what I did in this specific trade is that instead of entering for the entire price of the order block, or the imbalance trading, or the order block entirely, would be right here. But instead, I actually went and say, hey, you know what? I'm just gonna take the wick as the order block. Instead of taking the entire order block, I'm just gonna take the wick, and that's gonna be my entry point. So I let it run. Notice something as well, that this was identified on July 26th, and the trade was actually placed way later on. Here in the middle of that specific transaction, I found that there was an imbalance right there. You see the imbalance? This jump right here, it was a clear imbalance on that specific asset. So I enter a call or a buy order, but guess what? Yeah, I lost it. Why? Because the imbalance wasn't as big as I should have actually seen. So I lost the transaction. So what happened is that, first of all, there's an order block right here that was actually respected, but I didn't enter that specific trade. Thankfully, look, because we would have lost it. But take a look at it. This is what's important in regards to order blocks and imbalance. You see all this space right here needs to be filled out eventually. Okay. So when you see an imbalance like this, institutions will place their positions in order to fill out that space right here, just like I have my pending order. So what happened there is that the price actually went all the way to this area and got all the pending orders that institutions had. It activated all of them. It could have activated right here, but like I said, I got the order block just from the wick, which was even more sniper order, and then it went directly to the take profit, which was up 5.93. That's basically what imbalance trading is. Now, when you use the combination is when you actually start seeing some real results. Now, I see here a imbalance trading. One thing that I noticed right here, it was a huge jump, an imbalance trading from here as well. The exact same resistance support line that you see right here. It was based on this order block forming from this specific candlestick right here, the red one. This is a 4.43 risk reward ratio. It touched and it literally started going up one more time. Look, if this is being too complicated for you, you need to rewatch this video many times, because if you continue to trade only with moving averages and with stochastic and stuff, yeah, you're gonna have some decent results. But this is what's going to turn you into not being a profitable trader, or the way to being a profitable trader. Okay. I noticed there is no imbalance or order blocks or anything like that. So I need to wait. This right here, if you notice, is a huge resistance going on from a long time, but it's not an imbalance. So this is where a lot of people probably traded, but not us, because we're looking for an institutional position. Okay. So we wait for it. Right here, we see an imbalance position, and this is super crazy. But all of this is a consolidation area. If we even go and look at a 1 hour chart, in 1 hour charts, we can see all the consolidation, manipulation, and then distribution. So this would have been the perfect entry, which is exactly where I entered the position. Even though I had an order block right here, take a look at the sniper entry on this one. Take a look at it. It literally touched and started to drop. Okay, now it became a profitable trade with 5.19 risk reward ratio, which is amazingly crazy. Okay, then I identify a new order block right here. There's a opposite candle before the big movement of the market. Even though it wasn't that secure that specific position. And the reason why it wasn't that secured, it was because the movement wasn't that big. But I still entered. It almost hit the stop loss, but still gave me a winner of 5.57% in profits. I want to make sure that before we finish with this video, you know when to enter and when to exit the positions. This is not about a 10-to-1 risk reward ratio where with one trade, you're going to have 20% profit. This is not what it is. In this specific trading style, you need to know when to enter and when to exit. And in order to know when to enter, when to exit, you need to actually understand that there are higher and lower levels. Easy peasy. First of all, the entry point, whenever you see an order block, is going to be the entire candle. Now this one, well, it will be the entire candle, which means at the beginning of this candle, which is right here, and the closing will be at the end of the candle. All right. That's going to be the entry point and the stop loss. And if you notice, I even put the stop loss slightly lower than the actual end of the candlestick in case the price goes to that level one more time. So the entry point, again, in the order block is the entire candlestick, and the stop loss slightly outside of the order block so that you can have still some time to win. Now, how do you choose to take profit? You need to actually go into the next highest level, which in this specific case, for instance, right here, I see that this is a high level or high resistance point that has been respected. Therefore, I think that's my exit point. I can't really go and say, hey, you know what, it's going to go like this and I'm going to make 20% in profit. No, it didn't happen. Actually, it went back, it touched the stop loss, and then you lost it. So you need to know where you're going to exit before you enter with the position. This one right here is another example. Obviously, the stop loss is below the candlestick, and the take profit is at a level that was going to be respected. For instance, this support line right here, all of the previous candlesticks were actually getting to that level. As you can see, this was a previous high, and we don't go all the way to right here. We stay right there. I mean, 5.48 is an insanely good risk reward ratio. This one right here, why did I go to this area? Because I see that I have a low position in right here, and I can actually say, hey, you know what? This level right here is the one that is going to be touched. Even though the price went all the way right here, I don't care. I'm going to exit the trade according to my analysis and according to what I know. Okay. This one right here, again, you actually have the stop loss right below the actual order block. And then the take profit, you're going to find a level that it's being respected. This one right here is being respected many times. This is a good resistance line. You see, respected, touched, touched, and touched. So that's how you actually decide when to enter and when to exit certain trades. Now, in this last part of the video, I want to answer, when should you trade or when to trade? Look, there are going to be news all the time when it comes to Forex. So you should avoid those news depending on the time frame that you're going to be using. You could be really affected. Because if you're going to be trading with 50-minute charts, then every news are actually going to affect, the market. But I do recommend you to actually trade this during the New York session. It's basically when most of the trades are actually taking place. If you notice, the New York session is the one that I have right here in like lightly gray. And most of the good trades actually happen at the beginning or at the end of the New York session. So here at the beginning is when I got the entry, and at the end of the day is when it was activated and finished. This one right here, at the beginning or prior to the opening of the market, is when it showed me what was going to happen, and then boom, right here, it was activated during the middle of the day. Here, if you notice, we didn't have any trades. Here, it was in the middle of the day. Here, it was at the beginning of the session. Here, we didn't have any trades. Here, we didn't have any trades. Here, it happened literally before the opening of the market. This one right here. So for instance, my local time, New York session, I think is at 8 a.m. I usually am up from like 5:30 a.m. and I get those trades before the New York session, but it's during that time. Okay. Asia session or London session, I usually don't trade, and I don't see that many opportunities, to be honest, that I'm missing or something like that. So those times I think are the best ones, and I personally only trade this method with Euro USD, and I do pretty good. Hey, so hopefully you enjoyed this content of this video, and if you did, smash the like button, support this YouTube channel. But more importantly, if you have any questions or comments to share, you can always use the comment section below, and my team will be happy to reply to you. Thank you very much for watching this video, and I'll see you on the next one.